volatility of volatility. There's a symbol for that called VVIX, the volatility on volatility. Let's go to the next slide. We put together a little piece here to talk about volatility on volatility because volatility measures the VIX and the /VX measure the volatility of the S&P 500. But what measures the volatility of volatility? And that's VVIX. John, next slide. So the VIX, often referred to as the fear index, gauges the market's expectation of 30-day volatility for the S&P 500. Like the SPX, the VIX is a cash index and is not tradable directly. But it does have an options market. I mean, the underlying's not tradable unless you use the futures, but there's ETFs that trade volatility and there's options that trade volatility. Traders can engage in VIX options to speculate on the future value. The VIX, which indicates the implied volatility of the SPX, has its own implied volatility called VVIX. That's the volatility of volatility. So here's a summary of some of the key similarities and differences. I'm not going to read through this whole thing, but you guys can later on, if anybody wants to get into the nitty-gritty here. We just provided a crap load of research. What's important here is the VIX is negatively correlated with the SPX about 85, 87% of the time. And the VVIX is positively correlated to the VIX because when volatility goes up in the S&Ps, it's going to go up in volatility itself. That's the main takeaway from this. So the long-term correlation between the VIX and VVIX stands at 0.87, which should make sense to everybody because those two should be, like I said before, it's about an 87% correlation, inverse correlation between the S&Ps and volatility, meaning when volatility goes up, S&Ps go down. When S&Ps go down, volatility goes up. And which would make sense that the long-term correlation between the volatility of the S&Ps and the volatility of volatility also stands at about 0.87, meaning that they move in the same direction. So the VVIX generally ranges between 60 and 200, although we almost never get to 60 and we almost never get to 200. 70+% of the occurrences fall between 85 and 110. Where's the current VVIX, Tony?
Good question. I'll take a look for you right now. VVIX is trading at, it closed at 108.47.
Which would be considered to be, which we would consider to be a little bit on the high side.
A little bit on the high side. I mean, like this year, it's gotten up to around 140-ish, and that was that was actually at the end of last year. I mean, this year it got up to around 120 something and down to around 90 something. So
yeah, rarely do you see volatility in the 70s or 80s, and rarely do you see it much over 120. So
that is correct.
We're in that range, but a little on the high side right now. Let's go next slide. It's good for trading when it's over 100. Both the VIX and VVIX are measures of implied volatility, but VVIX is generally more volatile than the VIX. Sure, because volatility on a more volatile index is going to be higher than volatility on a less volatile index. Currently, both the VIX and VVIX are above their long-term median values due to the recent market pullback, indicating expectations of wider trading ranges and uncertainty in the near term, of course. And this makes for more opportunity. More uncertainty, more opportunity. You can see here the long-term median average for VVIX is 93, and we are at 108 and change. So while they are generally positively correlated, they can diverge from their median values in opposite directions. Since last year's election, we've observed a lower VIX, yet a higher VVIX. This suggests that the market sees lower potential volatility for the SPX, but there's increasing uncertainty about this volatility prediction. I think this is actually a good slide. The long-term median VIX is 17. The past 4 months are 15.5. But on the other hand, the VVIX, the long-term median is 93, and the past 4 months have been 99. Doesn't make a hell of a lot of sense, but it is what it is. And I think they described it here very nicely. There's increasing uncertainty about this volatility prediction. So the ratio, VVIX to VIX, the ratio is a valuable tool for option traders to assess current risk dynamics. The ratio typically decreases as the VIX increases. Since the election, the median VIX has been 16 with a VVIX VIX ratio of 6.3. Currently, the VIX is trading near 20 while the ratio is 5.4, aligning with the long-term data. Yeah, I'm not sure that we would use this that often, but it is interesting to see the chart on the right-hand side of the page.
Yeah. I don't know if it's something I'm going to set up, but yes, it seems
understood.
It's a good to know.
It's a good to know. Fundamentally, both the VIX and the VVIX provide a straightforward yet simple mathematical representation of option pricing. The VIX tells us the premium levels for the SPX, while the VVIX reflects an option premium for the VIX. The dynamics of the VIX and the VVIX are driven by supply and demand within the option markets for both the SPX and the VIX. Increased buying pressure raises implied volatility and vice versa. Just a game of supply and demand. It always has been. That game is never going to change. And some of the takeaways. The VIX and the VVIX both measure implied volatility. VIX is for SPX, VVIX is for VIX options. Unlike most underlying assets and their implied volatilities, the VIX and VVIX are highly correlated in the same direction, 0.87. The VVIX typically ranges between 85 and 110, and it's currently near the high end, but not at extreme levels. And currently a higher VIX results in a lower VVIX-VIX ratio. A lot of takeaways in there, but just a good discussion on volatility.